Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra and with me today is Ritu Singh joining from the Bangalore studio. Ritu, good morning, and we're somewhere in the middle right now. We are off 50 points from the highs of the day but up 50 points from the lows of the day as well. But yes, below that 26,000 mark which we did cross today. Mid caps are lagging and there are select names which are not doing so well. But the auto index, that is the one which is the top gainer as we speak. It's been quite volatile so far. But nevertheless, mid-caps continue to be on our radar on the back of earnings reactions. Yesterday, this index was one of the top gainers, but today there seems to be some profit booking. It did recover from the lows after falling from opening highs. So again, not a definitive move on mid-caps for now. But Ritu, we are very close to the end of earnings season. So a lot of numbers trickling in, and how?
Well, we are in the last lap, hi Sonal, of that earnings season, but that doesn't mean there's very few numbers to look at. A whole host of earnings lined up today that the markets will be reacting to. Yeah, the broader market pain continues, but look at the market breadth. It started well, but now those lines have crossed, and now, more stocks are declining than they are advancing. You talked about the auto sector, but look at some of the PSU names, for instance. SBI is one such name. Pull that up. It's surged in just the last half hour of trade. In fact, it's one of the only PSUs that is in the green. Apart from that, auto, pharma, PSU, these are some of the indices that are doing well. IT, energy, metals on the downside. But let's also get you a quick check of where the macros for the day are. The rupee, now that was a star performer yesterday after that sustained pressure that we've seen. It gained, in fact, almost 0.25% because of the inflows, and it was one of the better performing currencies across the emerging markets. Today, again, we're seeing the rupee appreciate further in trade, now trading at 90.5 to the dollar on the back of a softer dollar as well. The 10-year yield, though, it got some support from the favorable liquidity conditions, the higher foreign inflows that have been coming in the debt segment as well. You have the 10-year, the benchmark yield, slightly higher today, 6.73 is where it currently is trading. And crude prices, of course, they continue to track all those developments in the US-Iran peace talks. Now higher, Brent higher by about, 0.5%. That's at 69.2. So that's where the setup is today. But, a whole host of numbers that we've been focusing on. Let's start with Eicher Motors. Now, that is one stock that's trading higher in trade today after posting a very good set of third quarter numbers. Sudarshan is joining in to do all the number crunching for us and what stood out from their earnings. Sudarshan.
So it's a top Nifty gainer, up currently more than 6%. Till last quarter for Eicher Motors, there was one concern related to the margin, because margin was under pressure till Q2 FY26. Company was finding difficult to cross the level of 24 or say 24.5%. But this quarter, because of the operating leverage, better mix, and the company taking the price increase, now company has delivered margin of 25.5%. This is the highest that we have seen in the last 5 quarters. And also, company is saying that EBITDA has outperformed both revenue and volume growth after several quarters. On the volume front, both commercial vehicle as well as Royal Enfield continue to see healthy volume growth. In Q3 FY26, Royal Enfield volumes had increased by 21%. Commercial vehicle volume was up 24%. And because of this, in Q3 FY26, revenue has seen an increase of 23%. EBITDA has moved higher by 30%. And margin, as I've told you, it has come at 25.5% versus 24.2% in the same quarter last year. What about the outlook? Even outlook remains strong. For Q4, company is saying the strong momentum that has started post the GST rate cut and during the festive season, it will continue even in Q4 FY26, and even in FY27, company is saying that industry, that is motorcycle industry, may see high single-digit growth. So overall, because of the strong earnings and the positive outlook, you are seeing a big gain in Eicher shares.
Big gain, 6.5% as we speak, the top Nifty gainer. But you have another stock on your radar, Sudarshan, BHEL. It is slipping in trade today. The government has announced an offer for sale. Tell us more details. What does it mean and what kind of shareholders can subscribe to this right now?
So that was expected. It was about when does government announce that. Finally, government has come out and announced that it's going to sell up to 5% stake via offer for sale. So base size is 3% and the green shoe option, if government decides to exercise that, for that it would be 3%. And the floor price is rupees 254 per share, which was 8% discount to yesterday's closing price. And today also you can see that share price is hovering around 260 rupees per share. And total size, if you calculate as per 5% and at the floor price of rupees 254, total size comes around 4,420 crore. Now, of OFS for non-retail portion has opened today, and for retail portion, it will open tomorrow. And because of the discount that government has given, you are seeing a big downtick and currently down almost 6%.
Currently down almost 6%. Sudarshan, thanks very much for bringing us that update. We have to slip into a short break, but don't go anywhere. We're back with the bond market action with Manisha Gupta in just a bit.
And India Bonds presents Bond Street.
Welcome back. As promised, let's shift focus to the bond market. Manisha Gupta joins in as always. Manisha, over to you.
Thank you so much for that. On Bond Street today, I'm talking about various bond issues which is likely to hit the Indian private placement market for you to take a look at. Some very interesting names coming up though. The first one on my list is Tata Capital Housing Finance Limited. They are looking to raise 7.5 billion and they are trying to do this via the 2-year bonds therein. There's also Bajaj Finance looking to raise 10 billion rupees and they're also doing it through 2-year bonds. Both of these companies are inviting bids today itself. IFL Samasta Finance Limited is also looking to raise 2.75 billion. There is also Fincare Financial Services looking to raise 600 million. They're doing this via 12th November 2027 bonds therein. And then there is also Adani Ports Holdings Limited. They are looking to raise 15 billion through 3-year bonds there. Take a look at also at the Aptus Value Housing Finance India. They're looking to raise $1 billion via 5-year bonds. You have Small Industries Development Bank of India. They're looking to raise nearly 80 billion. This is through the April 9, 2029 bonds therein. You have National Bank of Finance Infrastructure and Development looking to raise 40 billion. They are doing this via 10-year bonds. And on the list also is Power Finance Corporation Limited. 40 billion is what they're looking to raise via 2 bonds. There is Immensity Office Parks Limited looking to raise 3 billion via 16th August 2030 bonds. There also is board approvals which have come in for REC Limited. They are looking to raise a big 1.5 trillion. This is via NCDs in 1 or more tranches therein. And then there is Prestige Estates looking to raise 20 billion. JSW is looking at 50 billion. Torrent Power Board also has approved nearly 30 billion via NCDs. And there are also approvals coming for Axis Bank, which is looking to raise 350 billion via debt. Bank of Maharashtra is looking at 100 billion via infra bonds. This is for FY26. So a long list, big list. Much of that is inviting bids in this week itself, something that you can go through.
Okay, interesting list there. Thank you so much for joining us, Manisha, with those updates. With that, we'll slip into a break. When we come back, we'll be joined by the manager of IndiQube Spaces to discuss their Q3 results and the way forward.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. You're still tuned into Trading Hour. IndiQube Spaces is the first management joining us on the show. The company's Q3 revenue surged while the EBITDA rose 32% during the quarter. Rishi Das, co-founder of IndiQube Spaces, joins us now. Rishi, good morning. Thank you so much for joining in. It's been a good quarter. You do have assets under management close to 10 million square feet as on Q3. Now, give us an outlook for FY27 because we're almost done with FY26, right? What kind of AUM growth are you targeting? What kind of seat addition would you see? And FY26, will you be ending with the growth that you saw in 9 months, which has come in at 37% revenue growth? EBITDA is up almost 80%.
Yeah. So thank you so much for giving us the opportunity to talk on this. And we are very confident that whatever we have achieved in the 9-month period, I think when we close the year, we should be pretty much on similar numbers. And as you talked about the guidance for the next year, I must highlight that as of now, if you look at our total area that we have, which is occupied, is about 6.3 to 6.5 million square feet. And our total AUM is about 9.5 million. So we have a headroom of almost 3.2 million square feet, which will get leased out pretty much over this quarter or the next year. So we have a lot of headroom for growth, and we are very hopeful that we should be north of 30% growth in FY27 as well.
To say
Okay.
headroom.
30% growth for FY27. Rishi, hi, this is Ritu. Your area under management, your center seats, they've all grown by about 19%, over the previous year. Occupancy has also improved to more than 80%. But as you expand, you add more cities and more centers, how will you ensure that this occupancy level doesn't get diluted? I mean, so to speak, what is the red line between growth and utilization?
So we are very focused on the occupancy along with the growth, and at the same time we maintain a good headroom for growth. So our philosophy has been that when we look at the entire country, we have classified the whole country into different micro markets. So there are about close to 50 micro markets which we believe are good performing micro markets. And when I say good performing micro markets, their occupancy levels in these micro markets are between 85 to 95%. So these are the good micro markets which we continuously track, and we look at basically deepening our presence in those micro markets to a newer supply additions. And if we choose our markets well, I think that is the first and the most important thing. And then we look at other factors like proximity to metro stations, the location advantage, picking up full buildings most of the time, unless until they happen to be grade A tech park kind of spaces, so that the assets needs to have a lot of defensibility in terms of its quality as well as in terms of its location. And then the last but most important is the quality of services. So as a result of that, our retention of clients has been very, very high.
Okay.
And that has ensured that occupancy levels are continuously high.
So around 84%, that's the occupancy.
Yes.
How much of it has come in from mature centers? What is the occupancy for new centers? How long before you break even? And just coming back to my first point, you said you'll be able to maintain the 9-month growth in FY27 as well, right?
Yes, yeah. Yes, that's true. And we have the classification that centers which are more than 12 months old, we classify them as steady state centers. And our occupancy in steady state centers is about 91%. At an overall portfolio level, we are at 84%. And if you look at less than 12 months centers, which is the other classification, will be about 81-82%. So that's the broad mix. Plus, from the time we start paying rent to our landlords for any property, we typically take 5 to 6 months to reach 50 to 60% occupancy. And that is our operational break-even. And in less than 12 months, we are able to reach 90% plus occupancy in most of our steady state centers.
So to assume within 5 months you achieve break-even in these new centers.
Yeah.
But, Rishi, your net debt has, become quite low. You also have some capital you're sitting on. Where would you be deploying that? I mean, are you looking at more expansion? What are the areas you're looking to enter, say, in the next 1 or 2 years? And what will be the highest drivers of growth? I mean, is it the top metro cities, the emerging markets? Give us a breakup of that.
Yeah, so basically, like as you are aware, we last year raised about 650 crores of capital. And a large part of that capital is already available with us. We used a part of it to repay our debt. And that is where you see our debt is extremely low over there. And the bulk of the money that we raised is going towards the capital expenditure for our expansion into fit outs and other stuff. And our lot of growth, I must say, in terms of area at least, is going to be in tier 1 cities, typically Bangalore, or look at other Mumbai, or for that matter, even NCR, Hyderabad, Chennai, all these major metros. And we will continue to grow into the tier 2 cities. Like, for example, if you see in the last year, we have added 3 new cities. And the last quarter, Q3, we added Bhubaneswar. So we see that city addition will continue to happen, even though the tier 2 cities are small in terms of their footprint. But yes, we see a lot of promising growth. So bulk of our growth in area will come from tier 1 with a lot of footprint expansion in tier 2.
Okay. Rishi, you mentioned that you have an AUM of 9.5 million square feet, out of which around 6.5 you're able to use. So there's some leeway for growth. So does that mean you'll not do more addition in your assets under management until you reach a level of utilization, or you will continue to add and that will get added by seat additions as well?
Yeah. So absolutely right. So AUM will continue to get added. If you look at, like, we have been adding 1.5 to 2 million every year. And we see that FY27 will be no different from that. And we have a good pipeline. And a lot of buildings which we take up, we mostly go when the buildings are getting constructed at the greenfield stage or under construction building. So as a result of that, we have a 12 to 18 month lag from the time any asset is signed up and by the time we occupy that asset. So the point I was highlighting was that this 3.2 million that we have immediately available, which will now start becoming available, large part of it in FY27. So that gives you an idea that from 6.3, if I have to go to 9.5 and I have to manage an occupancy level of 85% odd, there is a lot of growth that we are looking at happening due to this AUM. Plus AUM addition will continue to happen.
Okay. All right, Rishi, it was a pleasure speaking with you. Thank you so much for joining in today with your thoughts and the outlook on the business going forward. That's the word coming in from IndiQube. They expect the growth to continue, and this will be driven by additions across micro markets, be it tier 2 cities, but majority growth will come in from the tier 1 cities. Slip into a short break. When we come back, we'll discuss market fundamentals with Shiv Diwan, MD and head of Nuvama Institutional Equities, from the sidelines of the 21st Nuvama India Conference.
Welcome back. The frontline index now trading with gains of about 25 points, holding on to that 25,950 odd mark, still above the 26,000 level that we're watching out for. SBI, M&M, Eicher Motors, some of the names supporting, the markets in trade today, while HDFC Bank, and then you have some IT names like Infosys and TCS dragging the markets lower. But let's get in Shiv Diwan, the MD and head of Nuvama Institutional Equities, who is joining us now from the sidelines of the 21st Nuvama India Conference for his views. Shiv, thanks very much for being with us here on CNBC-TV18. To begin with, what's the mood like at the conference? You've been speaking to a whole host of companies and investors. What's your one big takeaway?
First of all, thank you so much for getting me on the show. It's been a great couple of days. Today we are on day 3, so hope this is the final day. And I think it's been a mix. We've had a huge number of domestics and international clients coming in. I think we're talking about almost 1,000 individual investors over these days. And I think the mood is interesting. On the one hand, we have quite a few people who are now starting to look at India from thinking that it's now becoming much better. Earnings are starting to sort of gradually come back. We are seeing some green shoots of recovery on that front. Initially last year around, we had some of these companies that had sort of gone up very high in terms of valuations, and earnings were yet to play catch up. We're starting to now see that slowly and steadily. I mean, you've seen some of the large names like Titan, L&T, SBI, etc., that have come up with good numbers. So the expectation is that from here on, things should start getting better.
All right. Shiv, most of last year, we saw these domestic flows being the big shock absorber for the markets. But now, the past few sessions, we've seen foreign investors come back. There's been some net buying that we're seeing on a day-to-day basis. What's your sense from, your FII clients you've been speaking to? More of a tactical trade, or structurally, are you seeing a shift that is underway with the trade deal that we have and some of the earnings improvement that you yourself spoke of as well? And where is this incremental money from the FIIs really getting allocated to?
No, it's interesting you mentioned that. Yes, we've had 7 months of negative flows from FPIs, and we've started off this month pretty well. We've had a few days of positive flows, so we're hoping that continues. But yes, based on obviously on the sidelines of this investor conference, we have been having multiple conversations. People are keenly watching this space in terms of where the pockets of growth are, where things are starting to look more interesting. There are, of course, a few sectors which I can get into later, but there is definitely an undercurrent that people do want to start looking at India, and I think to start off with the large caps, and then maybe a quarter or two out, I think you should start to see the same sort of excitement developing in mid caps and small caps as their earnings start to play catch up. So yeah, that's the way we're looking at it. Of course, I should also add the caveat that while valuations have become better on a relative basis to other emerging markets, I mean, at the start of last year, our premium to other emerging markets was at probably 70%. We're now at about 55%. So it has definitely come back to its long-term averages, and which is sort of got people to start looking back at India. But when you look at certain stock-specific or sector-specific action, there are names in India that are still a little more expensive than people would like, especially on the FII side. And the fact that we've been seeing strong domestic flows, for the last 48 months at a stretch, that gives us the feeling that you won't find the Indian markets becoming too cheap ever. So people will have to start to take that call sooner rather than later.
Okay, so when we talk about sector-specific calls that some of these investors will be taking, Shiv, what do the conversations suggest? Where are they finding comfort now? And what still looks very highly expensive to them? Or I would say they wouldn't want to put their money there.
So from an FPI perspective, I think banks obviously still take center stage. They still believe, most of these banks are looking good. And with the government's consumption push, with the recent rate cuts, banks are still in a good position. And I mean, we saw that with SBI's numbers as well. And like I said, I think this is a space that offers the kind of size and liquidity that FPIs would like. So that is definitely center stage. Autos, as a sector, has done really well, but people are still quite enthused about it. We're also starting to see some sort of excitement building up on chemicals after they come back from a longish capex cycle. So there are some green shoots of recovery there. And then healthcare and pharma is another space people like. I personally believe that, while tech has had a brunt of the pain over the last few months for various reasons, and the most recent one being AI, which has, taken up a lot of conversations over the last few weeks and especially over the last 2-3 days. But numbers and have seemed to have sort of come off quite a bit there. And so that could be an interesting play over the next few quarters if they sort of are able to pivot from, being a service-oriented play to a sort of solution-oriented play.
Shiv,
those are some of the sectors that we've had multiple discussions.
So, Shiv, when FPIs were taking money out of Indian markets, the conversation was that maybe it's because of uncertainty around US-India trade deal. That's what the impact we saw on rupee as well. The other was there's not enough earnings recovery that is coming by. Some of it is getting reversed, right? We are seeing earnings recovery in select mid-caps. Now we have some finality on US-India trade deal as well. What are the other risk factors now that market participants should be aware of, or they are talking about it in the conference?
So I think you're absolutely right. The Europe trade agreement, the US trade agreement, all this is a step in the right direction. Government's consumption push, the rate cuts, all of this has been a very big positive from an India standpoint. The one concern which is common across a lot of the FPIs we speak to is still, like I said, the valuations. Not everything is still, very cheap. And despite the fact that you've seen, countries like Taiwan, Korea, China, Japan do extremely well, you still have a fair amount of pockets of stocks there that are still trading cheaper. And this is what most FPIs tend to highlight. Discounts or rather the premium at which some of these Indian good quality names trade at is still anywhere between 30 to 50%. So that's the only concern that people have. And like I mentioned earlier, that because of the domestic flows, I'm not sure whether that premium is going to change anytime soon. So people will have to take a call at some point as to whether they are starting to see that growth and earnings recovery and want to start getting in early.
Shiv, just a couple of things. I wanted to dwell a little more on the IT space, because the markets seem to be trading those companies more on this global AI news flow and what's happening every day with new models and the disruption that may cause than the company fundamentals. We've seen a bit of a decent quarter from some of the big heavyweight IT names here, and yet you're seeing the kind of rout you're seeing in the IT space. What will trigger a re-rating from here? Any view also, secondly, on the mid-cap space?
Sure. No, I think on the IT pack, look, I think today, of course, there was some news around the H-1B visas, etc. This keeps coming every now and then. I don't think there's too much to read into that. But even over the last week, 10 days after what Anthropic and Palantir have been saying, there has been concern around, what happens to, employment on the IT side. But if you talk to some of the larger companies, and in fact, some of the good quality, high quality mid-cap IT names, they've been categorically saying that, look, IT is going through a little bit of a shift. We've seen this time and again, in the past many years, that every 5, 7, 8 years, you see some sort of a shift that takes place in this sector, and then most of these companies tend to come back. This time around, it's just slightly different because there is a little bit of risk in terms of, how employment is going to play out. But having said that, I think it's going to eventually have a positive impact on margins for these IT companies. And someone who can pivot extremely fast towards being solution-oriented rather than service-oriented, as I mentioned earlier, is probably going to be the prime beneficiary here. So it may not be as easy for every single IT company to come out of it, but at least those that can showcase this movement, I think should do extremely well over the next few quarters. And sorry, on your question on mid-caps, look, typically, when this kind of a cycle is playing out in the markets, it is the large caps that start to bring about the whole recovery process, and then the mid caps and small caps soon follow. I don't think this year is going to be any different. So for the first few quarters, it'll be a little bit more bottom up with large caps leading the way, and then as you go across this calendar year, you should start to see the small and mid caps also take part in this rally. But of course, it is not going to be extremely broad-based. It is definitely going to be far more of a stock-specific year than it was maybe 2 years ago.
All right, should we leave it at that? Thanks very much for taking time out and joining us from your conference, and we wish you the best with it. Thanks very much. Okay, we'll slip into a short break, but up next, we're going to be joined by the management of Jain Resources to discuss their third quarter numbers and more.
Welcome back. You're still tuned into Trading Hour. Jain Resource recycling in the stock on our radar. It is declining in trade today despite reporting good set of Q3 numbers. Managing Director Kamlesh Jain joins in to discuss the company's outlook and the way forward. Mr. Jain, good afternoon. Thank you. Good morning. Thank you so much for joining in. You are doing revenues of around 2,700 crore rupees per quarter. What kind of capacity utilization are you sitting at currently, and what kind of direction can you give? What number will you end the year with, and the outlook for FY27 as well?
So the capacity utilization is maximum for lead. We utilize almost I think above 90%, and we are going to further enhance the capacity. And for copper, we are doing almost 60%. We already have bigger infrastructure, and now we are getting more and more raw material. So the capacity utilized will be very high in the years to come, in the months to come. And I don't think there's any problem to increase our production in copper.
Okay, so that's about capacity and capacity utilization. So once that capacity does come in, what kind of revenue numbers will you be doing it? If you can give us the quarterly run rate or the yearly number, because we are almost done with FY26 as well.
Yes. So if you see our historical growth, we've been growing at 40-50% year on year from last 10 years. And that's what the companies like a startup, say, it's a unicorn. In 10 years, we have grown to this level. And we were growing 40-50%, and I strongly believe that we will be growing for the next year at same growth rate. I cannot tell exact number, but I'm sure about that. The historical growth of the company will be maintained because we are coming with 4 new other facilities. So this growth will be maintained for sure. And as we have told today in our earnings call also today, that the 4 new facilities of Ahmedabad plant, our antimony recycling plant, and our copper cathode plant, and one more capacity is going to be added for the copper. So this will help us to maintain the CAGR of the historical growth.
Well, Mr. Jain, even though you've had a margin expansion at 7% plus kind of levels in the quarter, it's still lower than some of your peers that we can compare to. Is there a structural difference that's causing this in the product mix, etc.? And realistically, how much of the gap do you think you can bridge in the near term?
So we are a multi-product recycling company. We are not alone to stick to lead. We do copper, we do aluminium, we do tin, we are doing plastics, and we are also going to add 2-3 more metals. So our margins at different segments are at different level, and I cannot comment on others. But as we are going for the new value-added product from next year, which is our cathode plant and wire rod and our bus bar plant, that will definitely boost the EBITDA margin. Maybe around, I expect around 2% to boost our EBITDA margin bottom line, and which will happen from next year. And rest, if you compare with the peers, we are okay in the lead segment.
Okay, Mr. Jain, very quickly on your debt as well. I think after your IPO, when you did an interview with us, you had given us a guidance that your net debt will fall to about 500 crores. Where does it currently stand? And, when do you expect to remove it? Reduce it? What kind of trajectory should we expect going ahead?
So there are two reasons for the debt growth. Because one is we have taken one big tender, which has the temporary jump in the inventory. And for that, we have financed that temporary jump in the tender, which is a big quantity of copper has come together. That is one. And I already said today in earnings call that this inventory will go down in next 3 months and will come down to the realistic terms, and it will reduce the debt to extent of almost, 300-400 crores. And the copper price also double when the last interview we had with me. And from that time, the price of copper has gone double. So the working cycle and working capital requirement also gone up to next level. That reason, the debt has gone up, but I am very sure. These are non-fund debts. Actually, these are not fund-based debts. Are non-fund debts which we open the LC to a supplier, and these materials are on the way. So this you cannot call actually in terms of debt, but it's a non-fund debts which will get reduced in the next quarter.
This is right now because of high copper prices that you had to take on. You needed more working capital basically, and that is the reason there hasn't been a reduction immediately. But that is something that you're promising could happen in the near future, the reduction in debt.
Yes, you're right.
Okay. Mr. Jain, I wanted your take on the EBITDA per ton as well, because it's highest for copper, followed by aluminium, and then you have lead. Do you maintain those levels, which is around 42,000 for copper, 18,000 for lead, and around 21,000 for aluminium? What is the chance of doing it better than that? And as you're saying, copper prices are rising. Does that impact your margins in any way? It's just for an understanding purpose that I wanted to understand.
Yeah, if you see the average of the whole year, copper EBITDA per ton is around, I think, 48 rupees approximately. I'm not the exact figure, but approximately 48 rupees for the whole year average. And I expect this EBITDA to go up to a very good level because of the value-added product what we are manufacturing. And from next year, our 4 new products are going to come, which is a copper anode, cathodes, wire rods, and bus bar. And in that 4 product, our definitely our value EBITDA of copper is going to go up to a great level. I can share the exact numbers later, but I know it is going to go up from next year.
Okay. Great levels. We would have liked that number, but you specifically said you'll share that later. Will it be around that 50,000 mark when you say great level? What is that number?
Of course, above 50,000.
Above 50,000. By when would that happen?
If I want to give more confidence, it must be above 55.
Okay, by when would that happen?
We are going to start our production by next month for copper cathodes. So next financial quarter, the first quarter of the next financial year, you will see the numbers.
So will it only be for copper, or will it happen for lead and aluminium as well?
It is mainly for copper, and other, I think, will be maintained or a little bit up, but mainly for copper, there is sharp jump.
All right, take that point. Thank you, Mr. Jain, for joining in today and giving us the outlook on the business, the capacity addition and EBITDA per ton for different products as well. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you more on the markets on the other side.
Welcome back. The frontline index, Nifty, still up about 17 points, giving up some gains, but the Sensex has slipped into the red. It's now down about 13 to 15 points as we speak. But let's again get you a check on the macro signal because we have some latest data coming in from RBI. Now, the latest data from RBI shows that credit card spends are growing, but the pace is actually cooling down. So the spends, they rose about 8.9% year-on-year to 2.05 lakh crores for the month of December, which is sharply slower than the near 14% growth that we saw a year ago. Now, on a month-on-month basis, though, credit card spends overall have jumped about 8.4%, and that is because of year-end discretionary demand picking up and steady e-commerce activity, which has continued throughout. But overall, the per-card spending has also risen to about 17,712 rupees for the month of December, which is up 8% month-on-month, which means per card, people are spending more. Again, you have your year-end promotions, e-commerce sales, a lot of travel, which could have led to that kind of a growth. Although year-on-year, it was again modest at just 2%. Now, credit card penetration, it is rising because the outstanding credit cards have also increased to about 11.6 crores in December. That's up from 10.8 crore a year ago. But the credit card market itself, it is structurally concentrated, as we've been telling you, the top 5 to 8 players accounting for more than 80% of the total spends. And that shows you the dominance of some of these large PSUs and larger private banks with their wider distribution networks. Private sector banks, they do remain dominant in the network, accounting for 72.5% of the total spends in December, though that is importantly a reduction of 375 basis points over the previous year. Public sector banks, on the other hand, continue to gain some of the market share, with their spending share rising to about 22.2% from 17.7% in the last year. In terms of the top players in the market, no surprises there. HDFC Bank continues to maintain its lead both in number of cards and the spend. And then you have SBI Card, ICICI Bank, Axis Bank, Kotak, RBL, etc. Finally, digital, which is online e-commerce, that continues to dominate the usage of credit cards, with 61% of all the transactions that are done being done online. So, the bottom line is the spending on credit cards is going up. Digital is remaining strong, but the growth, it is starting to normalize, perhaps also because of some of the RBI rules kicking in on unsecured lending over the course of last year. We're seeing some of that reflect on account of asset quality as well. So that's the big, macro cue to take note of on that
Ritu,
note.
Ritu, I would like, we have M&M's earnings which are flashing for you on the screen. Margins have come in absolutely in line with expectations at 14.7%. They have actually, for the labor code, they have accounted for an expense of 98 crore rupees in the quarter gone by. They do have taxes. There is a tax write-off that they have taken, which is higher on a YOY basis, but revenues, they are slightly lower than the expectations, which are 300 crores lower than the expectations, coming in at 38,500 crore rupees. The EBITDA number, that should flash for you because the margins are largely in line at 14.7%. The EBITDA at 5,668 crore rupees is largely in line with estimates. The estimate was 5,715 crore rupees. If you look at the breakup in terms of what the segments have done, the EBIT for automotive business has gone up to 2,625 crore rupees, which is an uptick both on a quarter-on-quarter and on a YOY basis. So in the automotive business, the EBIT has been quite strong. The farm equipment business, on the other hand, has seen a decline, both on a quarter-on-quarter and on a YOY basis. And that is where that miss is coming in from. So the farm equipment business is the one where we have seen some decline. In fact, let's get in Sudarshan. He's joining in with the analysis on this one. Sudarshan, over to you.
Numbers are largely looking in line with our expectations. If you talk about the profit, is coming at 3,931 crore versus our expectation of 3,900 crore. And revenue too, it's a slight miss against our expectation. It has come at 38,517 crore versus 38,843 crore. And EBITDA too has come at below 5,700 crore. But margin though has come in largely in line with our expectations of 14.7%. And revenue growth that you are seeing is largely led by volume growth. Both auto and agri segment have seen healthy volume growth, and company continues to gain the market share in the tractor segment. For the last few quarters, that company has been gaining in the market share. And we have to look at the internals of the auto and the farm segment. The margin, I'm yet to look at that. But overall, numbers are not looking that bad. And talking about the outlook also, if you would have seen, most of the OEMs have increased the outlook for FY26 and also for Q4 FY26. But so far, numbers are looking largely in line.
In line with estimates, let's actually do one thing. Let's get in Gurmeet Chadda, Managing Partner and CIO, Complete Circle, with his analysis on the numbers. Gurmeet, what did you make of the numbers? Largely in line with what the street was suggesting, but if you also look at the internals, the farm equipment business has seen a bit decline. The automotive business continues to do well. What do you make of the set? Gurmeet, can you hear me? Okay, all right. We'll get back to Gurmeet in just a bit. With the news that M&M's numbers just hit the exchanges, largely in-line set of numbers, margins at 14.7%, in line with expectations of 14.7%. The stock, though, has come off from the highs. We'll get in management commentary in just a bit. But with that, we'll wrap on this edition of Trading Hour. Stay tuned. Halftime report is up next.